Hey, hello everyone, and welcome to Traders Talk. As you know from before, the purpose of Traders Talk is to give you the truth of trading by interviewing top traders who trade for real and give you different ways to trade the markets for consistent performance. Today's speaker that we have on Traders Talk is Richard Hargreaves. Richard Hargreaves was educated as an engineer and conducted research in material science before entering the world of venture capital with 3i. After 10 years of making investments in smaller companies, he left to start Baronsmead PLC. He founded Endeavour Ventures Ltd, which invests in young technology companies from its 250 strong client base of high net worth individuals and mentors them as they grow. He has more than 30 years experience in the venture capital world. He has strong analytical, corporate finance, and entrepreneurial skills, and is a very experienced non-executive director and business angel. Richard, what a pleasure to have you on board today.
What a pleasure it is to be here. Thank you very much.
It's good to have you here today. So I think just before we get into the interview, just a couple of things. I really totally enjoyed reading your book. And in fact, I want to quote a few things from there as we go into the interview today. But before we do all of that, I just want to know a little bit, and for the audience listening in as well, like how did you get into this world of investment? How old were you when you started? What event triggered your interest?
Well,
do you do other things along as well?
Well, I was into the academic life. I have 3 degrees. I have a Ph.D. in electrical material science, nothing to do with finance. And at the end of that, I decided that to continue in research might have been interesting, but I wasn't in the right place. I spent a short spell in the civil service helping give out grants to specific research projects in universities. Whilst there, I got disenchanted with the government service, but interested in finance. Ironically, went back to see my careers person from Cambridge and said, hey, this is what I like, this is what I don't like, what do I do? He introduced me to 3i. And, so one thing led to another. So by accident, I think is the best way of describing it.
Interesting. Yeah. In fact, everybody that we have interviewed all of them land up in where they are today by accident. And in fact, I think always Steve Jobs quotes these things that actually you won't be able to connect the dots looking forward, but only looking backward, everything connects together. It's a very intelligent orchestration, isn't it?
No, and I think that's absolutely right. You do, of course, meet the occasional person who's always wanted to be a doctor.
Yes, exactly.
But most of us aren't like that. And along come opportunities. You can think of opportunities, probably we all can in life, where you didn't seize it, you didn't spot it, and there is some regret, but you go down a path. And at the end of the day, it's important to be able to look backwards and say, well, however crooked that path was, I'm quite glad with where I got to.
Richard, just a very quick side note. I was just listening to a podcast that you did an interview. One of the things that you mentioned, though, and it kept coming back again and again quite a bit, was jiu-jitsu. I mean, do you do some kind of martial arts or something?
No, not me.
I think, okay, so it was...
No, I've done sports, but I've done for a complete amateur, I've done serious running, and I've played squash and things like that, but no, martial arts, no.
All right. Okay, no problems. Going on into the your style of investment, what would you say your main style of investment is? From what I've read, am I right to say is more of a growth kind of investment rather than the value? What would you say it is?
Yes. Remember that we're talking investment in unquoted companies here, which is different to quoted companies, so we don't tend to use the same language. I'm looking for early stage growth businesses, or businesses that have the real potential to grow. I have, over the years, I've moved into being a professional business angel. I've also adopted a focus because it works for me, which is technology, early stage, business to business, because I don't understand consumers. And by the way, lots of people have ideas that might appeal to consumers. And then, and within that, it's mostly software and mostly SaaS type operating businesses. And through that focus, not only am I better able to look at something and say, hey, this is interesting, but I'm also able better then to work with them and say, well, I've got a network in this area and I can introduce you to X, Y, and Z who might be valuable. Because for these young companies, money is important, of course, or they don't exist, but they can benefit enormously from the advice, help, introductions from not necessarily from investors, but from other people. You know, they need to use everything that will help them succeed, because life is very difficult in that world.
So you would say, yes, I think then it would be mainly all towards growth, really, isn't
Yes,
it?
yes, that's absolutely right. Now, fine, of course, valuation when you invest is very important, but it's very difficult, because in the early stage, you know, how are you going to value something? Well, you can only really value it by looking forward and not by discounting back. And the reason I say you don't discount back is that their forward projections are so full of assumptions, you can't have confidence in them. So you have to say, hey, is this market big enough? Can they exist in this market? Have they got a product that will sell, or better of all, is selling? Can it be sold at this price? And so on. And by the way, you always in this world have to say, what will be my eventual exit? If you're a quoted trader, you know, your eventual exit will be you just sell it, you press a button and you sell in the market. If you're in an unquoted company, you are there until almost inevitably everybody sells. In other words, the company is sold or it goes public. You normally won't have an easy way out. I mean, I like to describe unquoted investment as saying it's something with no divorce clause. There is no easy route out once you're in until you all agree to sell. So it's a long-term, patient game, quite different to a lot of stock market investing.
So, Richard, you know, just for everyone listening in as well, I mean, most of our audience here are traders, but of course, as you all can appreciate, the principles you're going to talk about today in today's interview is always cross-transferable, and that's what I actually realized as I was reading Richard's books in how you value companies, how you look at companies, how you invest them, and I'm sure you guys will be seeing that as we go through. And of course, feel free to put any questions that you may have as well. You know, Richard, based on this investment in unquoted companies, I have asked you this before. What was there a reason why you chose this field of investment rather than opposed to quoted companies? I mean, I would say the first thing that comes to my mind would be the growth potential, because it's much more larger.
Yeah.
And you did an amazing investment with Blue Prism. I'm sure we'll be going through that much more in detail later on. But is there any other reasons why you chose this?
Yeah, I think I get a lot of my satisfaction, there is a lot of satisfaction to be gained from this besides the possibility of financial return and loss for that matter. I get a lot of my satisfaction from working with the teams. And I won't invest in something if I don't think I can contribute as a non-executive, not as an active investor, not an active member of the team. If I don't think I can contribute, and if I don't believe they believe I can contribute. And some of my most memorable moments have been when there's been a big problem of some sort. It might be being short of money, which is a common problem, but it might be a conflict on the board. It might be all sorts of things. And resolving those issues is, for me, one of the most satisfying things. So I like to work with the people. That is something that a normal stock market investor cannot do with a company. You know, they'll hear a presentation every 6 months and they can make a few comments back, but they're not in any sense close to helping solve its problems. So this is a much more involved world. You have to like that, you know, and again, if you don't know the people, don't even think about investing, because you're going to be stuck talking to that person for 5 years or 6 years or however long. So being closely involved, for me, is a critical part of it.
Okay, that's interesting. Yeah, you like the people interaction, which is good because you're just seeing the company grow as you go along. Now, you know, on page 15 and page 18, you talk about transparently all the investments that you've done to date so far. You talk about the age, the gender, the geographic, and all the stats you give. In fact, total investments you've made is about 42 investments, out of which about over 30 of them being tech investments.
Yeah.
What would you say the concept to most of your investment choices were in general? I know you give a really good checklist, very detailed checklist in
Yeah,
the book and
yeah,
everything, but what
yeah.
would you say, just to give us an overview?
Well, I have to say, because as you will have, I know you've read the book, and I do attempt in the book to be very open and honest. And I have actually never seen anybody else publish performance data as opposed to what's the average age of angels, where do they live, that kind of stuff.
Correct.
And then part of the reason for that is it's extremely difficult to collect the data. Whereas if you look at institutional private equity funds, those funds are making formal returns all the time to their investors, who are big institutional investors. So data is readily available. So if I'm honest about it, when I started, it was just things that appealed to me. Now, just things that appealed to me, including non-tech. And to be honest with you, it's in the book, I made no money out of non-tech. I didn't lose any money.
Interesting.
I mean, I did on individual investments, but I sort of just washed my face. So I began to realize that the thing I dealt with best was to get into a focus, some sort of a focus, not too narrow, but a focus. So my focus is tech, early stage, business to business, mostly software. And very often then, as software companies do, their first move once they get really established is to look to America. I have a lot of American experience. And I found the more I used a focus like that, first of all, the better I understand the businesses, the better I understand the world they're in, the better I understand the obvious exit mechanisms, in other words, which in the case of these companies is mostly trade sales, not IPO. So, you need to say, well, who could it be sold to? And one of the attractions of business to business, one learns, is that they're not so obvious. Blue Prism you talked about, nobody knows the name Blue Prism. In a lot of their customers are banks. No bank customers named Blue Prism. It's helping their systems work more cheaply, more efficiently. But by the same token, it's not so obvious to think, I'm going to go into automating bank processes. It's obvious to think, as say, if we look at a current flotation, look at Wise, that started because the founder of Wise, who's Estonian, got a 15,000 bonus from his then employer, sends it to his family in Estonia and discovers only 14,500 arrived. And he was fairly cross, as you would be too. Oh, and then they sent him an invoice for some fees. So he said, this is ridiculously expensive. I could do something about it. But most of the things I do, you wouldn't have an individual consumer like that making that observation. So that protection from competition by being less visible is attractive.
Interesting. I think you really put some really key points there in terms of your entry. You said tech companies, early stage, business to business, and mainly USA based. I mean, did it take you some time to narrow it down?
Yes.
All right.
Yes. I mean, the 42 investments that I use in the book, and of course the total number has changed a bit since then, was over 15 years, and it got more intensive later because that's what I sort of spent most of my time doing. My approach, my philosophy, my focus has developed over time. Now, part of the purpose of writing the book was to say, hey, I've learned a lot of lessons here, made loads and loads of mistakes. If I can communicate to other people, give them some sense of here are some things to be aware of which are positive, and here are some things to be aware of that are rather dangerous, then that piece of education is a useful thing to contribute. And it comes back to me liking to, help people solve problems.
Nice. In the book, you talk about whenever an angel investor invests into a company, you're looking at about at least an average of about 2 or 3 rounds of investment, which in the trading world we call it, I mean, scaling into the trade, right? You're putting more in.
Yes.
Would you say that has happened in your experience as well over the 42 investments? I mean,
yes. Look. If you've got a number of investors, what happens? The first place people get money from is their own bank account, which is probably empty. Then they talk to mum and dad and family, and they get some more. And then they talk to angels. Normally they talk to VC a little bit later, partly because of the quantum of investment a VC player wants to put in. And If it's an early stage company, you don't, if you think from the projections, which will be wrong anyway, it's going to take £3 million to get to break even, and that'll take 2 years. You don't give them £3 million at the front, because they're going to, one thing you know about money is that people spend it.
Correct.
So maybe collectively give them £500,000, which will give them 9 months, 12 months before they need more money. Needs to be 6, 9, 12 months, because otherwise you're not seeing any progress to measure whether it's sensible to come in again. So there will be an expectation that they'll come back for more money. Now, the other side of that coin is if your first half a dozen investors are sitting there and it comes to another round of finance and other people are asked to come in, other people will always ask the question, are your existing investors reinvesting? If they say no,
interesting.
The new investor thinks, hello, what does he know that I don't know? And sometimes others will invest at that point, but then they say, well, if you like a lot of not investing, we're going to really knock the price down and dilute you. So you have to make the assumption that people will be back for more money. The general rule is people don't achieve the detail of their plan. They'll have a plan as to where they're going. To project the future when you've got almost no trading is nigh on impossible. It will almost, however carefully you do it, it will almost inevitably finish up being over optimistic. So, assume they're going to ask for more money. And so in the book, I argue, look, if you're going to invest in a company, just assume they're going to ask you for some more money, and therefore judge the amount you put in accordingly. The other rule I put in the book is you do not know which ones are going to succeed. If you did, you wouldn't back the other ones. So you don't know. So don't go around saying, I really fancy this one, I'll put 50 in this one and only 10 in that one, because it may well be that it's the one you put 10 into that does best. So actually I'm not suggesting people put the same amount of money into everything, but you need to be sort of sensible, because you really don't know which will succeed. Would come back to your mention of Blue Prism. Blue Prism is a company that does a thing called robotic process automation, which automates manual intervention in computer processes. And a very common thing that they've done is automating mortgage processing, mortgage applications. Lots of clerks filling in forms on computer screens, and that automation avoids that need. Now, that company, as it happened, raised sort of $1.5 million in its early 2 years, and then it went a further 10 years without raising money before it went public. A consequence of it not raising more and more money was that at the peak of the market price for Blue Prism, investors who had were on 200 times their money. I mean, a huge multiple of money. Had lots and lots of money been raised, of course, that multiple would have declined. So there is a case, if it can be done, for raising as little money as can see you through. If you start raising money from other people and they dilute you, you've got to be aware of that in your overall returns. Now, you also mentioned the sort of value, and the trouble is with a very early stage company, how do you value it? Which is extremely difficult. And I work on the basis, I don't trust their projections other than the short term at all. But I say to myself, is this product succeeding in this market? Is the demand, is the market big enough for them to grow quite big without dominating the market? And then I say to myself, look at the proposed entry price, let's call it £5 million valuing the company. Can I see the possibility that we can sell this company for 50 million, the existing company, meaning if more people come in, I get diluted. So I see the possibility of making 10 times my money without being stupid, but by being realistic about the future. And unless the answer is yes, I will say no to that, because I know I'm going to lose sort of half my investments. A number of them are going to, return money or return a very modest multiple. I'm looking for the top, and all the data supports this, I'm looking for the top 15% of the investments to make 10 times or more my money to to cover the losses and to make a profit overall. So entry valuation is very important. And, you know, one sort of dangerous thing that anybody listening might be tempted to do is crowdfunding. And for example, with crowdfunding, you don't have enough knowledge to do that exercise properly. And I think a lot of crowdfunding things are grossly overvalued. There was a recent case, I can't remember which it was, but I think it was one of the challenger banks. It wasn't Revolut, which did crowdfunding, and then it went public 2 years later, and people made 2.5 times their money. We're saying, oh, isn't that a fantastic score? And my attitude is, no, that was not a big enough score given how much progress had been made. It was overvalued. And that 2.5 times should have been 10 times, which should have paid for all the rubbish ones that you did. So really, it's a much more difficult game than at first it appears.
Okay, you know, Richard, you know, just listening through all of that on how you actually gauge an entry, I wrote down 3 main points. Tell me if I'm right or wrong. You would first see if the product is succeeding in the market. Second is that you see if there's enough demand in this market for the product. And can you then, the third thing being, can you like at least 5 times your money? Is that right to say, more or less?
Yeah, something like, but the question on the product, is the product suited to the market? Well, you can really only answer that when it's trading. You know, in other words, customers have bought the product. Otherwise, are they going to buy it? Well, that's difficult. You're not, when you start off, likely to be overwhelmed with demand. That will develop, but the price is very important. You know, the product may sell, but will it sell at the price we're trying to sell it at?
Yes.
Maybe not. And maybe the price it'll sell at is so low that we can't make any profit. So that's, all of those things are extremely difficult. Whereas if the company is moving down the track, you can make some judgments. I mean, for example, there's a case study in the book, a company that became Sage Pay, which is a payment system used by Sage, the public company. And we were growing, and we were charging people so much per trade, so much per transaction that's conducted. And it was growing, but it just wasn't growing fast enough, because we found quite a lot of people signed up to the service, and they were little companies, and the service was allowing them to make their website financially able. In other words, you could actually order product from the website. And the product we have was called a payment gateway, which interacted between the website and the credit card company. And what we found was we had a myriad of small customers who fancied their own website. Yeah, we'll have a financial button here, and they didn't trade. They just didn't. It didn't happen. This is 10 years ago. And we changed, and it was clear we were not going to get to break even anytime fast, because the revenue was growing much slower than the customers were growing. So we changed. Instead of saying it's 5p a transaction, we said it's £20 a month. You get 1,000 transactions thrown in, and then you get a transactional fee. Overnight, but it was a ballsy decision, because we didn't know whether everybody would then say, nah, I don't fancy that. In fact, almost everybody took up the offer, and overnight our revenue multiplied 5-fold. Because
yes, I remember reading that one. Yes,
and then it grew. You know, then the company grew really well, and it was sold to Sage for a lot of money, because it was a better solution than the solution that they had. The company was called Protex, and when Sage bought it, they first used the Protex name, because a lot of customers said, we don't want to change it. We like the name Protex, but eventually it was changed to Sage Pay. So there was an example where we were underpricing, in the sense we weren't left with something that's going to make profits for the company, and we had to take what was quite a difficult decision to completely change the pricing model, which worked, but we didn't know.
Yeah. Because, you know, the pricing was actually the solution in this scenario. And I remember you quoting in the book that, in fact, I mean, 99% of all the customers still retained, and they
Oh no,
keep
no,
buying.
yes, it was massive majority. And as I say, and immediately we had a fivefold increase in revenue from, not very much to five times, not very much. And then it grew, and what happened was it grew predictably. And also we happened by chance to have we didn't have a sales team. We didn't have a sales department. We had been chosen by HSBC, I think it was, as a partner. A merchant, a retailer would come to HSBC and say, oh, what we want a website. You want to sell through our website. And HSBC would say, well, fine, you're going to need a merchant ID. We've got those. But you also need a payment gateway. We haven't got one of those. Our preferred partner is Protex. And those things came to us at sort of 100 a month, 200 a month. And all we had to do was process these online forms. We didn't have a sales force at all. It all was just, in the early days, it was all just flowing through that. And the sorts of problems we hit then were not related to customers inbound and so on. It was criminals trying to bring our website down. I mean, one, it turned out, who had a go, the police said they were Russian crooks, and they were asking for a bribe, or we'll take your website down. And the police said, whatever you do, don't pay them, because then everyone in the world will have a go. And the one which was much more sophisticated, the police reckoned were Californian school kids.
Wow.
Got a much more sophisticated approach. And ironically, it took our host down. Their big attack took our host down, but it didn't take us down. And so that sort of thing, which was existential, if they had really taken us down for any length of time, we were out of business. Because if we'd gone out for 2 days, the customers would have all lost faith in us. So there were nasty issues. But what I'm saying is, at the beginning of all that process, we didn't know all of this. Mm-hmm. We learned these things, and we had to adapt. And that's incredibly important in a young growth company. It has to adapt, because life will not be quite as they thought it was going to be.
It's a very important principle, in fact, in everything that we do in life, isn't it? Adaptability. In terms of, Richard, on all these entries and all that, before we go on to risk management, what would you say your best trade to date so far is? And was your thinking behind that entry into the investment the same as everything else?
Well, the best for me, my best one was Blue Prism, we referred to earlier, mm-hmm. where I sort of made 100 times my money. I made money at various points. When he went public, we had to either take some money out or be locked for 12 months. I took some money out. And then as the price rose on the market, I was taking money out. So that meant I didn't achieve the maximum that could have been achieved if I'd waited till the top of the market and sold all my shares. An unlikely scenario. Now, if I look back on it, did I think Blue Prism was going to be some mega success when I first saw it? No, I did not. I liked the people. I liked what they were doing. And that was it. And I thought, well, hey, we've come in, this small thing, we're paying quite a low price to get in. It could do okay. I didn't envisage, for example, that later down the track, we had 2 venture capital players in there, and we suddenly hit a really bad problem. They wanted money out. And the management was saying, hold on a minute, every pound that's coming in from trading, we're feeding back into building the business. And it got really vicious. And eventually we got a meeting on the subject. And I thought there was going to be a punch-up. I mean, it was nearly as bad as that. And I listened to them for 3 hours. I made various suggestions and got punched, as it were. And after 3 hours, everybody's getting tired. And I've been listening. And I said, look, I've now got a proposal that gives each of you something of what you want, allows you to retain your dignity, and most importantly, creates peace between us. To my considerable surprise, that was agreed. Now, if it hadn't been, I think the company could have failed. Ironically, we had a takeover offer about 3 months after that from a big public company, whom, as it turned out, none of us trusted. And we were acting as a group because everybody was now on one side. We were acting as a group. But part of the reason that company went public was one of those VCs wanted liquidity. One or two other people wanted liquidity. The management didn't want to sell shares at all because they wanted to run the business. And so going public was a route to allowing some people to get out and others to continue, which a trade sale, of course, wouldn't easily have done. So no, it was my biggest success. Did I think it was going to be my biggest success? No. If I think of my second biggest success, did I think it was going to be my second biggest success? No. If I think of my third biggest success, the answer is no again, which not to say I didn't think they were going to do okay, but I did not see them making, sort of 30, 50 and 100 times my money.
Okay, interesting. Yeah. So the process was almost similar, it was consistency, but then eventually.
Well, also what it also says is don't rely on one investment. You might put some money into a friend's business and hoping you'll make some money, but actually helping your friend. So you don't see it as a true market investment activity. If you're going to do a true market activity, you have to spread your risk. Well, any stock market investor would do that too. But the problem with this game is you can't exit from those you now don't fancy. So you have to see them either through to success or death. You can't come out halfway. Very rarely can you come out halfway through. Occasionally with the successful ones, you get the chance to sell some shares part way down the track.
Richard, moving on to risk management, you see especially in the financial markets, we use stop losses, trading stop losses to reduce our loss and everything. So in terms of angel investment, what would you say the various risk management techniques that you guys would use? I know you mentioned a lot about the EIS scheme as well, which reduces the risk quite a bit in terms of tax reliefs. Another thing is that, would you say also asset allocation and how much you invest your money is a huge part in this game to manage risk?
Yes. Well, first of all, I've argued you must spread your risk. And so I think if you're going to say, I'm going to do some angel investing, you shouldn't think of doing less than 10. I'm not saying you do 10 in the next 3 months. Maybe take 2 years to do that. But you must spread your risk because it is high risk and you just do not know which you're going to succeed and which you're going to fail. Now, having said I'm going to invest, you can do things that do reduce the risk. So, for example, if the deal is we, the investors, get our money back before anybody makes any profit, which is one of the things I argue for in the book. So if we put 3 million in between us and we've got 20% of the company, shall I say, and the manager to say put in £50,000, I want a set of rules that says if we get £3,050,000 for this company, we all get our money back. Not you, the management, makes money whilst we lose money. So you can do structural things. Now, you talked about EIS. With EIS, you can't do what a lot of VCs do, which is to say, I'll put some money into ordinary shares and I'll put some into a preference share or a loan stock. So a more protected first ranking instrument. With EIS, you need to be in ordinary shares. You can play the game I just said of everybody getting their money back before anybody makes a profit, because that can be seen as a class right. With EIS, the attraction, the enterprise investment scheme, is that when you invest, and for the sake of our conversation here, most of the companies that we would be talking about here would qualify for it. When you invest, you can claim 30% of that investment back against your income tax. It must be against income tax. It mustn't be claiming a tax rebate when you haven't been paying tax. So you can claim 30% back. So you've now got 70% of your money at risk. If it then becomes a big success and you've followed the rules, which you're not entirely in control of, but if it becomes a big success and you've held the shares for 3 years, the gain will be tax-free. So that's a benefit. If it fails, remember you've only got 70% of your money at risk because you've had 30% back. You can choose to put that 70% against your income tax. And so if you're a high income taxpayer, 40 or 45%, again, you can reduce the loss quite sharply. So if you have a loss of failure on EIS, you can bring the loss down, you can get it down to only losing 40% of your investment rather than 100%, which is, of course, a helpful thing. So you are risk managing thanks to the government. And why are the government giving you tax advantages? The reason is angel investing is crucial to the UK economy. You know, we need young companies. Young companies growing are a much more important source of jobs than big companies. They contribute jobs, they contribute tax, they contribute all sorts of things to the economy. So governments of all shapes and forms have liked it. And if you're at the lower end, as I said earlier, VCs won't come into the lower end. So you need angels as that bridge between friends and family and VC funding, if you do ever have VC funding. And that's why it's tax advantaged. Now, it has been used rather improperly when certain government people were very keen on solar electricity, solar generated electricity and so on. And, you know, they started mucking about with the rules. And there've been scheme operators who try to offer you guaranteed returns using, as it were, tax shelter, many of which have finished up in very bad shape indeed. I'm talking about investing in real growth companies. Well, they don't have to be growth to get the relief. So I would say the three obvious risk things. One is to take advantage of EIS wherever possible. The other is to structure the investment to minimize risk. And the third is to be close enough to give advice and help, you know, where it might be needed and where you can contribute something, because that could be all sorts of problems as they go down the track.
Interesting. Yeah, it's just like how you did with Blue Prism, with getting into that meeting and
just to give you another little example, my public company Boku, which does a thing called direct carrier billing, which means you can charge a digital purchase to your phone bill. Not a big deal here, but big deal in the Far East. Actually, our biggest market is Japan, and we are sole supplier of that particular service to Apple worldwide.
Wow.
It's a very nice business. But when we went public 3 years ago, that was, you know, seen as quite a success, as you would expect. But the chairman stood up in front of the staff and he said, look, he said, this is a great day, we've gone public. And I would just like to remind those of you who've been involved long enough, on our mission from startup to getting here, we had 5 near-death experiences.
Wow.
Meaning they were about to run out of money, and they pivoted. And pivoting in this world means, you know, you change quite strongly what you're doing or who you're doing it for or whatever. You just have to adapt. Coming back to the point you made earlier, you have to be capable of adapting.
It's an essential principle, isn't it, Richard? I mean, we have found that not only in business, but throughout everything that we do is a very essential quality and of course, of any entrepreneur as well, that willingness to adapt and adapt fast and be spontaneous. Going on into the last question on risk management, what would you say, Richard, is the trait that taught you the biggest lesson? Now, before you answer that, I just remembered also, you know, that there's a very nice thing that you mentioned in the book. It was very clear as well. You had a 10-point checklist and on reward and risk and how to assess an opportunity. So definitely highly recommend everyone who's going to read the book, you know, Business Angel Investing, to read that before you do your investments. But now coming back into that question again, what would you say is the trait that taught you the biggest lesson?
Well, that's quite a hard question to answer, but there is an investment, and I'm foolish enough to mention it in the book, that we kept going and we kept buying the story that it was going to be all right on the night. And we finished up, I'm embarrassed to say, with 14 investments. We invested 14 times.
Wow.
And at the end of the day, it still essentially failed. I mean, you know, we sold it to the management, but it was to put it in American speak, it was living dead. You know, it wasn't going to go anywhere, and we didn't stop. Coming back to your point about stop loss, where one of the things you do is say, I have made a loss now. I'm not putting any more money in. I'm putting good money after bad. That is very hard to do because you're desperate to see it succeed. The management is desperate for it to succeed. So they're going to tell you a story and you want to believe it. You want to believe it. And eventually history teaches you no. But as I say, that was embarrassing.
What do you think that taught you, and what have you done from that experience to stop you investing that many times into a company?
Well, I've had moments. I haven't. Most things that are going to fail, it's evident that something is critically wrong, and you shouldn't put more money in. It is that moment of saying no, where when you say no, I mean, you as a group of investors say no, you are essentially putting the thing to death because it's not going to succeed. Sorry, not succeed, but survive. And that is difficult. That is difficult. But there are times when you've just got to do it. You just got to say, look, that's it. I accept now that my investment's a write-off. Now, what can happen is you've got investors in a business, and I have one like this, where things haven't gone well. There's still amongst some people vision of the future. And you try and get all the investors to invest, and they won't. And so you say, well, fine, if you're not going to invest, we're going to bring the price down so low that your shares will be worthless. We're going to take over the whole business. If you do that, that would, at extreme, would be called a wipeout round. If you do that, it's not a very nice thing to do. But if you do it, you then have to do something with the management, because you don't want the management wiped out. You have to give them more shares by options or something. And I have a company that we struggled with for a long time, and we've been through 4 CEOs, all sorts of board changes, and we decided to have one last throw of the dice, and it was fairly brutal. We got kicked we kicked out the chief executive, the chairman, almost all of the board, the people who are prepared to put some money up. We put the chap in charge, who'd been the original chief technology officer, the CTO, and it has now roaring along. I mean, it has become really a very nice business indeed, doing extremely well. So in doing our rather brutal financing, we're going to do, out of that financing, we're going to make a lot of money. We've all got some old money to recover, as it were. And were we so very clever in choosing the CEO at the time? He was almost the last man standing. He looked as if he could be a CEO, and in fact, he's turned out to be absolutely excellent. So that wasn't a piece of brilliant headhunting.
It's interesting, isn't it? I mean, we've heard that time and again. Sometimes the person that you think will do the best job, sometimes, and the person that you hired and you think that he will do the best job, sometimes turns out to be not the person who will.
You've only got to look at FTSE 100 companies. Think how many times they've hired people who turned out to be awful. We have the investors, or it's certainly in my investment world. In the UK, you tend to look at people who failed as not backable. Americans look at it differently. They say, well, actually, you learn from failure. It is the thing you learn from, and therefore it's not seen as so important. If you remember the little story I tell in the book about Peter Thiel, who was a founder of PayPal, and he was interviewed on a BBC radio program some years back, and the program was called something like The Success of Silicon Valley. And they interviewed Peter, and he said, Silicon Valley isn't about success; it's about failure. He said, my first 7 ventures failed. And if we hadn't changed the whole strategy at the end of year 1 with PayPal, that would have failed too. But of course, what's missing from that statement is in Silicon Valley, although most businesses fail, some, when they succeed beyond the wildest dreams.
Interesting.
Like PayPal, for example. And here I rather rudely saying in this country, the only things that failure doesn't seem to be a drawback is CEOs of FTSE 100 companies and football managers, all of whom get rehired.
Yeah, very, very well said. Just on the thing of risk management, if I were to nail it down to 2 points before we go on to targets and exits, would you say from all your investments that you have learned, have you now today put like maybe a time factor as a stop loss, or the amount of investment as part of your risk management, so that to stop such the scenarios of investing 14 times, have you said something like, okay, if the company doesn't do well in about 5-6 years, I might stop, or maybe
No.
after 30, 40 or 100,000 I would stop?
Mhm.
Anything like that you have done?
Yeah, well, I think that, for everybody, there's a limit to how much money you're
Hmm.
prepared to have down that particular hole, as it were. And in a sense, what you've got to do when a new financing comes along,
Hmm.
if it's a difficult situation, is think of your old money as lost.
Okay.
Would I invest now, given everything I know? Because if the answer is I wouldn't invest now, if I were new, that there's something wrong with the company or the terms or whatever, you shouldn't really be following the old money. But there isn't any way you can sort of get out. There isn't a stop loss approach of getting out partway down the track. You can say I'm not going to invest, and if only a few of you say that, then you're probably all right, in the sense that nobody gets brutal. My example earlier where we got brutal was partly deliberately to dilute certain people who were hostile and weren't going to invest anyway, but partly to encourage people to set the terms so that it was extremely attractive to come in. No, I think you've just got to keep watching it and keep judging it as you go along. Because the example I gave you where that wipeout round really worked, that was, we'd made a judgment at the time this was worth one more roll of the dice. Now, if that CEO hadn't transformed the business, we were all clear that was our last financing.
Got you.
That was it. But you don't have the same freedom to make those decisions that you do in the quoted world.
Interesting. Now we move on to the last section, Richard, in terms of exits, and you've explained quite a lot, even in the book as well.
Yeah.
One question that I did have is, I think I asked you this before as well. When you invest into unquoted companies, do you look at the probability of them getting quoted and listed so that your potential of multiplying your money increases?
No. Generally speaking, the most money you'll make in a defined period is from a trade sale. I'll come back to that. The IPO, of course, do you see that as the end of the journey or a continuation of the journey? And probably you need to see it's a continuation. I'll give you the Boku I was describing earlier, the direct carrier billing company. We went public at a particular point. Our share price has gone up sort of 3 times since then. And that's a representation of the progress that we've made. So it's a continuing investment where, of course, I could, if I happen to be a director, so it's a bit difficult to sell, but I could have sold my shares. So, and the reason that the trade sale can be particularly good is that if you've got a business that has established a niche, a business you and I talked about yesterday, which is called Living Lens, which does converts video feedback into usable data for companies, media companies and brands who want to understand how customers are feeling. That company was sold just before lockdown for something like 15 times revenue, which would be much higher value than you would normally attribute to something. And that's because for the buyer, it allowed them to acquire a product they could use across their portfolio of businesses. And it was less risky for them to pay a huge price relatively for this little thing than to pay a bunch of people to try and develop the software to do it. And that buying Living Lens got them there. It got them there immediately. So you can see opportunities where the exit price, is as it were too big to refuse. And of course, the good news about trade sale is you get all your money. In a public offering, you probably don't. So you're forced to keep some riding with it. So no, most of my companies don't go public. I think only about 3 have gone public down the road. And these things can, even in the public markets, you see these things that change. I have a friend who's a director of a public company, and it had just done revenue of £70 million. It was a software business, and he said, as we looked forward, our most ambitious target for next year was 100 million. Somebody came and bid for it, who had big sales network. They bid for it. First year in their hands, it turned over £1 billion. Now, they could never have done that. So for the company that bought, it was a steal, given they then turned over £1 billion. So the trade, although that was a trade buy from a public situation, the trade buy has the 2 advantages. The price can be very high, and it can be very clean in the sense you get all your money back. On the other hand, if the company is going to continue developing, that's it. You've lost your investment, and you probably can't continue investing.
But Richard, even from your small sample study of, it's not even small, it's quite relatively large, of 42 investments. Even in that small sample, and you've showed the stats as well of those investments which made more than 5 times, 10 times, Blue Prism being one of them.
Yeah.
But even in that sample of those making the largest amount of returns, Blue Prism is also one which came out to IPO and continued, and that's one of the reasons why you were able to 200 times your money, if let's say if you didn't sell it throughout. So then wouldn't you say that looking first at a company upon entry to see the probability of them getting to IPO and growing further and their price increasing would be an important enough consideration to make?
Yes, but if you think, but to look at something and say, oh, I'm going to make 100 times my money here is just, everything says that's not a realistic assumption, which is why I use the test in the book of saying, look at it and say, can I see a realistic possibility, not based on doing financial analysis, of making 10 times my money? That's good return, pays for a lot of mistakes, and it's not a daft thing. It's not a daft thing to do, especially if the thing starts off valued at 3 or 4 million or something. To get the shares that are then in issue worth 50 million is something you can see where you need to be. You can see when you might get there, most of which won't turn out to be quite right. But that is very important. One is looking to the exit the whole time. Otherwise you're just a long-term investor, which is fine, but you're going to make no return out of that. You're not going to be able to bank that or take some of the money and invest in another one. And a lot of the fun is that I did invest in that, and I came out at a certain multiple of my money. And if you get several bites of that cherry, that's interesting. I have one company which is now just about majority owned by Santander. It's a foreign exchange dealer by its background, called Ebri Partners. There was an opportunity down the road when somebody came in with a lot of money and they were prepared to buy shares. So people could take out some money at, shall I say, 8 times the amount they paid. It was then heavily bought, so that by Santander. So Santander is just over 50%. That was done a year ago. And that was at, if I look back to the first round, there were 2 rounds, that was 35 times money. And now we still each have 55% of the shares we started off with in this Santander company. And the question is, what's going to happen next? And the next will be that gets sold. Santander buys us out. They take it public. So there's another big payout, unless something disastrous happens. There's another big payout due, but we don't know what it is. So that would be, 3 points of exit or partial exit.
Mm.
But that's unusual. That's unusual. Usually, you're either all in or all out, or if the thing goes public, maybe you take half your shares out on public offering if you can do so.
Richard, in terms of how you said, in terms of 3 times exits and partial exits and staging your exits, sometimes even in your book, you've talked about this, and I've seen this example being quoted in quite a lot of articles as well, where they always say, if you had invested in a Steve Jobs company, unquoted company, and kept your money throughout until now, a $10,000, it would turn into 20 million or 50 million, or even Warren Buffett's Berkshire Hathaway. My question to you is that, does that happen really practically on the ground? Because in fact, what you have said is practically, even for you, you have taken your money out on stages. So so does that person exist where they've kept that $10,000? I know Warren Buffett said that there was one person that did.
Well, it's interesting because of course risk management would say you've got in this game anyway, you've got limited times when there's liquidity. So take some profit off the table. Just, for example, when Blue Prism went public, I took an amount out which was a multiple of my total investment. I'm now in zero cost and I made a profit. As it happens, the better trade would have been not to take any out and sold them later. And then the price kept going up. It was quoted at 78p. And it peaked at £26, I think. And I just had a simple rule. It was really crude, which was every time we went through a £1 mark, £1, £2, I took a little bit out, because you don't know what's going to happen next. And now it's public, and I wasn't on the board. I was not privy to what was going on. So that's part of it's stop loss. It's not stop loss, is it? But it's certainly risk management. And no, you're right. You see, if you invest in Microsoft or Apple when they went public, you would have made a massive amount of money if you kept it all now, but you wouldn't. You'd have taken some out, and the person who'd be cross would be the person who took all their money out. See, when Blue Prism went public, there were 2 small VCs in there. One because of their own rules, which was it was a local area VC in Liverpool. It had to take, the rules were you have to sell out on public offering. So they made, shall I say, 8 times their money, and they missed out on massive amounts of profit because the rules said you shouldn't hold any shares.
Richard, I must say, throughout the whole investment game and trading, in fact, all the strategies that we have done on statistical modeling and everything, the principles still are the same. It's only the 5-10% that will keep running and they will not look back. Yes. But however, of course, looking forward, how do you know that is going to be that 5 or 10%? Yeah. And
if you knew it, if you knew it, you'd be richer than your wildest dreams, and you wouldn't be bothering it. Because you don't.
And then sometimes you put some rules, but one thing we have observed, at least in the trading world, is that the winners, the true winners, they never look back. They have a steady, clean, good run, at least in terms of statistical modeling and looking at markets. They don't go through any crazy kind of shocks or turns. They're more or less quite steady. But in terms of on a mathematical perspective, you see mathematical perspective, and on the ground, I know it's totally different because the emotions come into play, and then you got the rules that you got to follow in terms of your risk management and all that. But one thing I must say, the power of compounding and all that goes against scaling out, right? And why do we do that then, knowing that? Because Warren Buffett's rule would be, whenever he buys a trade, he never looks to sell. Therefore, he's fully harnessing the power of compounding. So then my question to you back would be, would you then revisit your exit strategy going forward in terms of angel investment?
Well, look, remember, in my world, most of the time, what happens is an offer is made for the company to buy the whole thing, and the shareholders as a whole agree to take it. And I mean, for example, we were discussing earlier Protex, which became Sage Pay. we had an offer for the business, which was a lot of money relative to the amount people put in. And actually, we had a shareholders meeting where quite a lot of people were saying, don't sell because the price is too low. And other people were saying, do sell. And there was a bit in the middle. And we actually finished up having to vote on it. And it ended in peace because the don't sell people got voted against, and they then said, fine, we give up, we'll support the sale. And it's just very difficult. And of course, Warren Buffett, his all-time investment is Coca-Cola. Mm-hmm. And he bet on Coca-Cola on the basis that there will always be a demand for that, and it's going to be, and he actually also says, I will only invest in companies that can be run by idiots, because sooner or later they will be. Well, if in the very long term, that's probably right. You look at a number of our FTSE 100 companies, and at some point, most of them have had really bad management. They may have come through that and got good management again, or they may still have bad management. But that's if you really are there, as he has been a very, very long-term investor. But therefore, he's got to decide this is a very, very long-term investment. And at least he has got with his Coca-Cola shares, he's got the chance he could sell it. It would no doubt destroy the Coca-Cola share price if we got known that Warren Buffett has sold his whole holding. But we don't have that in the unquoted sort of world. You don't have the luxury. If there is a trade sale, you're all out. It might be if it's a trade sale to a quoted company, you could buy shares in the quoted company, but your bit might not be an important part of it. You don't normally have the luxury of staying on forever, unless, of course, it's a rotten company and you have no choice but to stay on forever, and you don't want to be there anyway. So there are similarities, but the differences are important.
Interesting, yeah. I would say Blue Prism is the closest example probably in your investments that you have carried on for the longest. Now, to end off, I know I'm just looking at time as well. I think one thing I did want to ask you, which was a very, very interesting quote in the book as well, which is on Steve Jobs' quote. And that's what I wanted to ask you before we go on into where they can get your book and find out more about you. Is that you said, Steve Jobs says that figure out what customers are going to want before they do. People don't know what they want till you show it to them. That's why I never rely on market research. I read the things that are not on the page. Based on that quote, Richard, I mean, what would you say today the sectors or the business opportunities would be that come close to that?
Well, you and I had a conversation about this, and it's a very difficult one. If there was a nice, easy answer, then I probably wouldn't want to tell you. I want to get a little group of people together and exploit it. And we were talking about blockchain, and blockchain, if you forget currency, I have deep reservations about it as currency.
Exactly, yeah.
It's much ttoo volatile for me to go and try to buy things with it. All right, a criminal will say, I only want digital currency, but blockchain currency, because it's untraceable. But as a technology, it has huge attractions. It's highly secure, and we're all suffering from lots of insecurities on the internet. It's very it keeps an absolute record of things very, very well, because you cannot change when it's in there. Once you put some information in there, it can't be changed unless all the parties agree to change, which they won't. I mean, it's just not practical. So you can see that technology being used in all sorts of ways. I was talking to somebody only this morning about somebody who's using a blockchain technology for, it sounds a bit odd, for, if you like, a charities funding site. And there are advantages there, because people can see what's happened. They know exactly what has been done, that their money won't go in different directions because it can't, and so on. So I suspect we're going to see a number of really radical things that come through there. And that's kind of different to, if you take Amazon, say. Amazon became very big, not only because it's extremely well managed, but because technology changed to suit it. The internet developed, cost of data changed downwards dramatically, power of computers changed upwards dramatically, people's access to internet changed dramatically with a smartphone, and all of a sudden, you've got the population obsessed with their smartphones, they're buying things, and Amazon happens to be, has got excellent logistics. But that was not, Amazon itself is not an originator of technology, say. But there are going to be things that will change. And I think blockchain is a very interesting concept to look at. Because if you look at, say, the challenger banks, they've not done anything especially great technologically speaking. They've just said, as we mentioned earlier, Wise, he's just said, hang on a minute, surely we can put this together and charge people less money. And all right, you need the technology to do that, but you can find people who can write that. It's not patentable technology. So I think at the moment I would probably say there'll be some very interesting things in blockchain, provided you forget currencies.
Would you say any companies that you have been following in terms of the blockchain technology space that? Not yet? Or?
No. I mentioned the one I was talking to this morning, and that was really quite interesting. I wasn't actually talking to them in the context of would I invest. A problem I find is that because I have a number of investments I'm quite close to, I'm on the board and I'm actively involved in the sense that I do get involved with them in various ways, and in ways I can't control. They'll suddenly contact me and say, Richard, please can you help with this? That you very easily get overwhelmed because investments and their demands on you are a bit like number 10, number 11 buses. You wait, nothing happens for a while, and then 3 arrive at the same time. And if they're all funding crises, that isn't much fun.
Okay, great. Yeah, I think that was a really good insight. That's the last question. I always ask this, to end off, usually our interviews, but we all know that most importantly in our everyday life, psychology is very important to keep our calm, to make the right decisions and all that. So in terms of that, is there any practices that you do to keep your mind in focus and your emotions calm when you make your decisions?
Well, I try. I am very bad at the word no. So I say to myself, I'm not making any investments this year. I'm not making any more investments this year, for example. Well, I break those sorts of resolutions because I think, I really get sucked in. So I could do with a bit more emotional control in that sense. But it's what, for me, gets me out. It's not. This is a bit too extreme, but it is the thing that gets me out of bed in the morning. Something, and then all of a sudden, I get an email from somebody, and something really fun has happened there. It might be good, and it might be fun and good, or it might be bad news, and that's just fun. And then there's this business of the huge satisfaction if there's a problem that I can contribute to. It is just hugely satisfying to do that. Hugely satisfying.
Very nice. Okay, so I think let me just share the screen in terms of your book over here, Business Angel Investing, where everyone can actually get a copy of that. Let me just quickly share our screen, and then everyone can take a look at where they can do it as well. You guys will also get an email as well. So that's where the book is. You can purchase that, and also for all our attendees and viewers over here, the registrants, you get also a discount code which gives you a 30% discount code. It's called TTalk30. We'll put that all in the email as well. So TTalk for Traders Talk and 30 for 30 to get your discount code. Richard, it's been a pleasure. Just one last thing is there anywhere else that people can follow you? People can get to know more about you?
Well, there's a podcast.
Okay.
Which some people might like to listen to. It's along the same lines as our conversation here, but it was not coming from the same angle as you do. It's done by a professional podcaster. Perhaps you could put that, you've got that link, perhaps you could pop that into that email. And a lot of people have been quite positive about that. Yeah, otherwise, I'm doing a number of things like this. So yes, they can. I can always be found. I can be found on LinkedIn, which I'm a very bad user of, or a thing I'm find much more interesting, and other people might find interesting, which is called virtual non-executive director. So, but actually, it's its initials VNXD, and that's a great way to meet people who are doing all sorts of stuff, not necessarily investment, but you can meet people who are doing investment. So I met the guy I was talking to about blockchain this morning through that network, which is
VNXT. Okay, that's great. I really enjoyed the interview. Any last words from you before we sign off?
I think if you've got a point I'm making in the book, if you're going to make angel investment, you must do it because you think it's fun. It's a roller coaster. It's a rocky road. You're going to get bad news. You're going to get good news from time to time. You need to be patient, sensible, and sophisticated about it. And if you're not enjoying it, it's a bit like, the betting stuff. When the fun stops, stop. This is almost as hard as stopping this as it is stopping that.
Thank you so much for the interview, Richard. And thank you so much for your time as well. I'm sure everyone will be enjoying this recording and this amazing insight that you have shared with us. And as we always say, till next time, stay disciplined, follow your trading plan, and keep trading like a master. Thank you, Richard.
Thank you very much indeed.
Bye. Bye.
Thank you. Goodbye.